Did you want me to start right now, Dan?
Yep, go ahead and start there. And then I also have some questions that you guys have seen ahead of time to kind of be prepared for some of the questions I'm going to be throwing at you. And then for those of you who are watching, if you have questions for our panel, I want you to dive in and put those questions into that Q&A box, and I'll make sure that we tee those up for the panelists as well. So I'll let you guys go ahead and go around and start the discussion.
Sure. Well, welcome everybody. My name is Anna Myers. I'm based out of the San Francisco Bay Area. How did I get involved in multifamily? My family actually has been commercial real estate for 3 generations now, but I did not start out in commercial real estate. I started out in the tech world as a programmer and a major data geek. But in 2006, I started investing in real estate, going back to my family roots, basically to avoid paying taxes on the money I was making in my business, as well as to get some side income. It became very clear about 2014 that my business that I had was basically a job that I owned, and I needed to exit that job that I owned. And what I decided to do is go real estate full time. So I created a 5-year plan. I guess I actually over excelled and completed it in 4 years, because in 2018 I joined Neil Bawa at Grow Capitus. I started working for him. I started volunteering actually at first. Basically investigating markets and data strategies on how to find specific markets, and also underwriting multifamily. Since joining Neil, we have purchased 5 apartment buildings and 1 new construction student housing with our investors' money, of course, totaling over 1,000 units. So that's in 6 different states. So I'm doing multifamily all day, every day now.
Thanks, Anna, and good to see you. Good to see everyone. Thanks for having me on, Dan. My name is Rob Beardsley. I'm also from San Francisco Bay Area, recently moved to New York, and not quite as illustrious of a family pedigree, but I grew up in a family household. My dad always tells me that I was in diapers on construction sites, and I too had a little diversion to tech. I studied information systems with data science in college, but had to come right back to real estate as a couple years ago. My dad, who is a Silicon Valley residential broker and developer and flipper, we wanted to get involved in multifamily. So we said, okay, how do we do this? What is this? We want to get into the more commercial, institutional side and obviously scale. And from that time, we got involved with people and wanted to reach out and learn just like on forums like this and learn from Neil and Anna. And we invested as LPs and got to get involved on the GP of some deals, and then we eventually got involved in actually acquiring financing and raising equity for our own deals and managing them from there. And today I do that under the name Lone Star Capital Group with my business partner Ken Petrikowski, and we're at almost 600 units in Houston.
Awesome.
Perfect. Thanks, Rob. Hello, everybody. Thanks for taking the time this Saturday. My name is JC Clements, based in Houston, Texas. And a little background on myself. I started out doing some apartment leasing in college is where I really got my start and kind of got my real estate fix. And then from there, graduated with a degree in real estate finance from the University of Texas in Austin. From there, went to Holiday Fenoglio and Fowler. I was at HFF for about 5 years on the mortgage banking analytics side, specifically focusing on multifamily. And then from there, transitioned over into multifamily investment sales, selling apartment complexes all across the state of Texas, everything from class C minus D deals all the way to core more sexy mixed use deals all over the country, and wanted to transition out of the brokerage side of the business and ended up getting onto the private side. And so I've been with Flagship Capital Partners, my current employer, for a little over 2 years now. We're strictly a capital provider. So we have one side of the shop that is a bridge debt financing platform. We're on our 4th fund there, and we focus mostly on multifamily bridge acquisitions, more on the middle market side. So we provide loans to people kind of $2 to $15 million on heavier lift value add deals. And then the other side of the shop is direct equity investments. So we have I believe we've put out probably close to $55 million over the past 3 years in kind of $1 to $5 million slugs as passive LP equity. So say a well-qualified group wants to go buy a multifamily deal and they want to put in 10% of the capital, we'll bring 90% of the capital and partner up with them. So we're truly a capital provider for groups that are looking for bridge financing or true equity, and have actually recently closed a deal with Rob. So we are actively in the market and looking forward to meet new owners and operators and people that are looking to build their portfolios.
Nice, welcome. That
Absolutely.
was nice to meet you, and great to have you here. You've got a wealth of experience that's going to be great to have. Great to know.
Glad to be here. Thank you.
And our other guests that are supposed to be joining us are not in here yet. So if they do join us towards the end, maybe they're having a little technical difficulty, we'll make sure that they come in and can participate with the conversation. But let's go ahead and dive in. And let's, for the rest of the session, I'm not going to have you guys go in any particular order. I want you guys to just kind of jump in as you feel like you can provide some value. So I would like for you guys to share some of the top metrics that you focus on while underwriting while you are underwriting a deal that you are analyzing right now.
Sure. So first and foremost, I think like everybody else, we're very IRR driven. People have a lot to say about IRR. Oh, it sometimes is confusing or it can be manipulated, but at the end of the day, it really can present just the discounted cash flow analysis in the most clearest way. And so understanding that metric well is number one, very important. And then from there, it's understanding how are we getting to that IRR? Is it primarily through cash flows, and is it more of a yield deal, or are we really banking on all of the back end appreciation, which is typically seen on more heavier lifts or value add? And between those two, it kind of influences what the IRR I'm looking for is. If I can get most of my return out of yield, then I'll accept a lower IRR. But if it's like a development deal and I'm banking all my IRR from the exit, then I really need higher IRR for the deal to make sense. So from there, that would be my number one.
I would say we definitely, for us, if I'll just put my three out there, that we're looking for the achievability of rents and rent growth. That is a primary thing that we're always looking for in the market. If you don't have that, then you don't have much for value add. And then we're also looking at the investor return. So we, like Rob, we focus on IRR. We also look at our average annualized return as well. But one thing that we focus on, and I think everybody, all syndicators should also focus on, is what are the returns for the syndicator? So we look at what's in it for us. We might have a deal where the investor has nice returns, but the actual money coming to the syndicator is so slim, and it's going to be a 10-year project or a 5-year project even, and it's just not something that's worth us spending our time on. And as syndicators, I think we all need to be honest about, we need to put our time where it's valuable. And that also speaks to our investors, because if we don't have enough money to run our business, and what we are doing, we're running a business, we need to be able to invest in our business. There's software, there's staffing, there's the various types of resources that we need. And if we're not bringing in enough money from our deals, then it's actually a disservice to our investors who are counting on us to be executing on that deal for 5 years or 7 years or 10 years. So we look at that metric to see what's in it for the syndicator. Are we able to run our business with this deal?
I actually agree with both of you on those metrics, and Anna, just to hit on your point as well, because I'm speaking more from the investor standpoint, and we want our GPs to be successful. And so at the end of the day, if a deal doesn't make sense, and I know I've told Rob this before too, is that at the end of the day, underwriting a multifamily deal is not rocket science. There's only so many inputs that can go into the deal. So we probably spend about 10% of our time really knowing and understanding the underwriting, and that's very important. But 90% of the time is getting good sponsors that can execute their business plan. And so for us, obviously, as Rob said, the IRR is what we're driven towards. Different investor groups, our investor group is definitely IRR driven, given that we're 3 to 5 year hold type guys. Obviously, people that are longer term holds are looking more at multiples, but also on the rents as Anna was saying, that's extremely important for us because in Houston, we're such a large market, and really all across Texas is where the majority of our deals are. And everybody has this illusion that if you just go in and put $7,000 into a unit, that you're automatically going to get a $200 rent increase. And for certain submarkets and for certain deals and for certain renters, that's just not in the cards. And so I think it's having a GP that really understands the market and is very realistic as to what rents you can achieve and how much capital that you're putting into each deal. So I 100% agree with both of the points that were previously said. And then I think a big one for me is really kind of a going in basis and then kind of what your exit looks like. So obviously my boss that started out the company, he was buying a lot of these C and D multifamily deals for 20, 30, 40 grand a unit from the RTC back in the 80s and 90s. And so now those deals are trading for 70, 80, 90 grand a unit. And it's hard for some investors to really understand that going in basis, but obviously if the numbers justify it, we get it. But we need to really understand what the exit cap is and how realistic that looks. Because if somebody's saying that a 1960s flat roof deal is going to be trading for 130, 140 a unit in suburban Houston, sure, you can probably get the numbers to make that happen, but you need to kind of step back into reality as an investor and say, all right, we need to make sure that that exit number is really going to be justified by the market.
Yeah, that's good. And then just to jump on the rent bump idea, something I look at a lot is just constantly looking back and forth between the T12 and then what's my year one pro forma. And maybe it's year one plus year two because it's going to take some time to get you all the way to your pro forma. But nonetheless, I see a lot of people who start out with, let's say $1 million in NOI and year one, they're already jumping to 1.6 and maybe, but those are the parts of the underwriting that should be substantiated. And so, yeah, to add to that, I'm looking at going in DSCR and then year one return on cost, and then what is the projected bump in revenue and then expenses and NOI from T12 to year one.
On one of our other panels, everything. Go ahead.
That's everything. There it all is in one big swoop. That's all. That's underwriting, all in one bucket.
Well, one of the things that we had talked about in one of the other panels earlier on was how that when you're looking at a deal, a lot of people don't like to go visit the property ahead of time as the person who's making that final decision, because it's more, at the end of the day, it's more of a numbers decision. Like, okay, what are the numbers saying? And you don't get emotionally caught up into the community around it or the feel of the property, and you get excited. So you kind of can sometimes, we all know we can manipulate a spreadsheet to give returns that whatever we want to give, because there's ways to do that sometimes people that aren't as savvy can not really understand. So it's definitely, underwriting is good, but you also, like JC said, have to make sure that you align yourself with proper and good operators at the same time, because underwriting on just one little space, one place here or there can modify the entire deal, But going back to what I was saying about that other panel discussion was really about not being emotionally caught up into a property and really just looking at the numbers. Because at the end of the day, it's really about the numbers. Like, do the numbers work? Do they work for the investor? And like to Anna's point, do they work for the sponsorship team too, to allow the deal to make sense for both parties? Because we both have to be aligned in that. So have you guys ever, put any things into place to make sure that that emotion does not get caught up into the underwriting?
Oh, sure, we do. We get presented with a lot of deals from a lot of different locations. People bring us deals that want to partner with us for equity and want us on their team. And so we see a lot of deals, and we turn a lot of them away. But the ones that we are very serious about, and we are going to be part of the team that's submitting the offer, we actually hire an independent underwriter, and that underwriter doesn't get the original underwriting model. They just get all of the materials. So that's how we completely take the emotion out of it. There is a stranger that is, looking at all of the numbers and doing, basically they don't have any emotion, because we love our partners. So we don't want to bring our emotions into it. So that's one part of it. But you also mentioned, Dan, that on that other panel, somebody was saying they don't necessarily like going to the property. I think going to the property is critical with, your construction team, your property manager, and getting all of the goods, because when you're submitting
Well, they do
offers
send
these days,
somebody to the team. It's just that the people who are
okay.
underwriting the deal don't go to it because they don't want the underwriting team to really have the people who are making the final decision, not necessarily just the underwriting team, but the people who are making the final decision aren't emotionally caught up in, the people and trying to help their condition and the way where the property is located and just the emotion surrounding some of the times, because we've all been to a property and we're like, man, this is a really good property. I really want it. And sometimes we kind of bend our underwriting rules a little bit, try to get that deal.
Right. Well, these days with money going hard right away, you have to be you really have to know your numbers, because you can get into some big trouble, real quick. So you really have to know your numbers.
Yeah, I think from our perspective, I think Flagship is in a unique position because the two principals of our company owned, operated, and developed over 50,000 units all across the country. And so there's really not a lot of emotion whenever they walk up to a property. And they can be really objective whenever they arrive and can look at a deal and see it. And I couldn't agree more with going and seeing the property and getting with the management team and speaking with them. I just think that is such a large part of the equation that a lot of people figure out, because we look at 50 or 60 deals a week from the equity perspective on multifamily, and I can make the numbers work on any deal. And so, as I said beforehand, I think the underwriting is probably 15-20% of the numbers. If they make sense, we're going to go to the property, and it's the management team and the sponsor that are going to make the deal work. The deal can pencil all day, and we've turned it down 100% of the time if the sponsorship doesn't make sense, or there's a property manager that doesn't understand the demographic that's renting the property and thinks that by them operating a deal 3 miles away that they know what they're talking about at that specific property, and that's just not true.
And I think to comment on Dan's point of going to the property and looking at we're all talking about qualitative inferences or qualitative data, such as, well, I really like the area. How do you really put that into numbers? And I really think that this property, because it has larger 3-bedroom units and it's walking distance from a great school, it's going to be sticky and there's going to be lower turnover. And there's other things that are qualitative about the deal. And I think the fun of underwriting is, how do you get those qualitative inputs to then factor into the quantitative of your underwriting. So, for example, if you think that this area is really up and coming and it's just going to take off and, let's say, gentrify, then you could simply say, okay, fine, well, we're going to have 3% rent growth here, or 3.5%. And so there's a way, that's a simple way to quantify it. And now people like to use rent growth as the way to make their numbers work. Like JC said, you could put 4% rent growth annually over 10 years and your property's, it's going to take off. So, yeah. So really it's being able to substantiate that, and you can use qualitative data, being on site, talking with the management, to kind of factor in. Maybe you think this property is going to do a little bit better in terms of the demand given its strategic location of the schools, and so you have a slightly lower vacancy rate. But it's all about finding ways to get those qualitative data into the quantitative spreadsheet
in a responsible way.
Yeah, in a responsible way. And just to add one more quick thing too, is that we've gone to properties that I've completely beaten up the underwriting, and we've gone and actually walked it and then come back and changed our assumptions, and those deals have performed and we've exited well and above that. So at the end of the day, we're in the business of doing deals, and we're in the business of doing quality deals. And so I'm going to put the most conservative underwriting into every deal that I do, but if I can go there with the sponsor and talk to the management team and say they're stealing a manager from the previous, owner, and they can tell me something, then maybe I will, decrease that vacancy, or maybe I will be, less aggressive on loss to lease or bad debt. But because as I always like to say, I like to be in the solution business, not in the business of killing deals just because, I want to do it so conservatively and hit a home run on every one of them.
Yeah, and those things that you just mentioned, those come from actually being with an experienced person on site, somebody that knows the market, they know the pulse of the market. You don't get that from these data-driven tools that are projecting operating expenses and revenue. I mean, that's a place to start, but you've got to at some point translate to the pulse of that micro neighborhood. and who knows it best. And you got to get away from the computer and get to the experts.
Absolutely.
What would you guys say if you were speaking to a passive investor, or if there's a passive investor listening right now that, they're kind of a little overwhelmed with all the underwriting. They don't have a lot of, a background knowledge in it, but they really want to kind of understand a few points of the underwriting that they should really focus on when they are looking at a deal that a sponsor is presenting to them. Do you have any feedback for that type of an investor that, just wants to have a couple of different points to really look at and to kind of have a high level approach to, vetting a deal?
Well, I would say that the levers that can be pulled to make a deal maybe better than it is are easily exit cap rate and rent forecast. So assumptions about growth, whether it's other income, growth of other income, growth of rents. These are things that they should look at and really vet hard, because those triggers, if they're not set correctly and they're overly optimistic, can make any deal look great. So those are two things that really should be scrutinized, that they are in reality: exit cap rate and growth assumptions of revenue.
I agree with that. And I think it's because those are the factors that can exponentially spin out an IRR because they're compounding annually. And so that's a major thing for me. And then also the financing. So that given where the financing is right now in the world, and obviously we have a finance side of our shop, so we're pretty in tune with what's going on in the private financing world, which is where we live, and then also with all the agency money. And there's some people that hear of their friends getting a sub 4% rate, interest only for 7 years, and they just put that in the underwriting, and they think that's what they can get. And we see a lot of people that put that in there. And I ask them if they have a quote or if they have a term sheet, and they go, no, but we've heard from a broker that that's what we can get. And so that's one thing also that can have a huge impact on these deals, is making sure that your general partner and whoever's buying the deal understands the financing, because it's a crucial piece of the puzzle.
Yeah, and the type of debt you're using definitely influences the level of return that you should be looking for out of the deal. If you're buying a nice core plus asset that can be financed 10-year agency debt, no interest rate risk, very little refinance risk, then you shouldn't be you shouldn't be looking for a home run, like you said. You should be looking for a 15% IRR, something in that neighborhood. Mm-hmm. But if your sponsor is buying a deal that is 70% occupied and has a lot of deferred maintenance and things like that, then you should see a 20% plus IRR. So I'd say to go back to the exit cap rate, the growth assumptions, and then also basis. JC made a good point about basis, and I think the best way to really look at that is your going in cap rate and your return on cost, because a lot of people only look at cap rates, but we're not buying bonds here. We're not buying just strictly financial products. We're buying things that can change in the underlying income. So we should be looking at, if we're going to spend $5,000 a unit to get a $7,500 bump, we should see what that actual return on cost is to determine if those numbers make sense.
And I'd just like to throw in something that's not necessarily in the Excel spreadsheet, but that I would encourage LP limited investors to be looking at the market. So to really understand, what is the market that asset is located in and the neighborhood, and what are the underlying fundamentals of that market? Is it a strong market? What if there is a turn in the economy? How is that market going to do? Who are the employers in the area? Is population leaving the area? Is population coming into the area? What are the jobs? So doing a little due diligence on the market and understanding who's going to live there.
I agree with that as well. I think last year we were in Ocala, Florida, Troy, Alabama, Cleveland, Ohio, and every major city in Texas, and job drivers, and just the story, local employment, historical occupancy, even during the recession. I mean, there's 1,000 different factors, and I forgot to mention that. That's a great point, Anna.
Yeah.
So let's have this discussion right now around cap rates. So obviously I want you to kind of talk about, what is your group currently right now looking at as far as cap rates are concerned? And, do you have a certain preference on cap rates and explaining why on that. And then also let's have the discussion of how important do you feel the cap rates are when you're actually trying to acquire the deal? And obviously cap rates change based on stabilized assets versus non-stabilized assets. There's a lot of factors that go into cap rates, but just want to start that conversation with you guys.
And I want to purposely misinterpret the question quickly and say, what is a cap rate, and what's my preferred cap rate? Not high cap rate, low cap rate, but the calculation of it. And just quickly go over it. Everyone has their own definition, but for me, my favorite cap rate is you can go T3 income, T12 expenses, and then take your year one taxes and put that into the T12 taxes. So it doesn't matter if the seller is currently paying $100,000 for taxes. If when you take over, you're going to be paying 200, that's what you should be looking at your cap rate. And then finally, factoring in your replacement reserves, which is typically $300 a unit, into the expenses. And then that's where you end up with your NOI and how you can calculate cap rate. So that's my quick start. Yep.
Yeah, that's a good point. So we actually feel that the cap rate as a concept is better designed for stabilized properties that, we're buying immediate value add properties. And so we feel like cap rate is better used for properties that are at market price and basically at their best and highest use. And if the focus when you're acquiring a property should be more on the plan and how you're able to execute that plan. And so if you're just focused on the cap rate, then you could be missing something. Now, so we're making offers on properties that are a 5 cap rate or even a little bit below that, because we feel that we can execute the plan to bump the rents, $150 to $200. We've walked away from properties that are 7 cap rate because we weren't confident that we could bump the rents. So sometimes people get really caught up on cap rate and miss that it's really about the quality of the project and the ability to deliver on the plan. Now, all of that being said, we understand market cap rates and we don't want to buy far below the market cap rate or anything like that. So we understand that it plays a role, but we feel that cap rates can be oversimplified when it comes to value add purchasing, and that the focus really needs to be on the quality of the project when you're making the decision about whether to acquire the asset or not. That the quality, the conviction, your conviction about your plan and the ability to deliver on it should be a higher priority than the fact that the cap rate is a little lower than something, So that's where we're thinking on cap rates.
Yeah, again, y'all are teeing this up for me. I agree with both of you. I want to get back to what Rob said, because I think it's important, because the focus of this is an underwriting call, is kind of who are you underwriting this deal towards? If you're trying to raise money, which I think is what a lot of people on this call are trying to do, I think Rob's underwriting approach is the way that I, as an investor who gives people money, looks at it. So I really don't care what you put in your model. I'm going to underwrite the deal how I want to. And the way that I underwrite the model is the way that Rob did. And so I think that everybody's like, well, I'm going to put reserves below the line and I'm going to really put this rent growth in there. I think the more conservative and more realistic you are on your underwriting, the more I'm going to take you seriously whenever a deal comes across my desk. And so I really do appreciate it whenever I see somebody who has a realistic pro forma. And then back to the cap rate deal, in all of the deals that we've looked at this year, I really don't think that our investment committee has had a single conversation about going in cap rates.
Exactly.
It really is not anything that we and we also invest in deals that have 100 down units, So, I mean, how do you put a cap rate on that? And so I really don't. Obviously, you're not going to go into, Houston, because that's my battleground. Is I'm not going to go in there and pay a 4 cap for something, but if it has 100 down units, I might. And so I think at the end of the day, for me, it's really exit cap rates. I think that's what the main focus is for me, is that if you think that your deal is so special that it's going to exit at a higher per unit than anything that's out in the market and at a lower cap rate than anything else, then I'm probably not going to invest my dollars with you. But if your deal makes sense and your exit is kind of in the middle of the pack as far as numbers, with the expectation and hope that you exit higher than that, then I'm probably going to consider it more deeply and dig deeper into it. I think it's all about having realistic expectations and projections, and probably under promising and over delivering, I think, is the focus, as is what I really like in a general partner. If the deal can make me a 16 or 17 over 3 to 5 years and it's underwritten conservatively, I'm going to be more excited about that deal than if somebody says, hey, I'm buying this deal at a 7 cap and I think I can exit at this high per unit and you're going to make a 30 IRR. I'm probably going to throw that OM away.
Mm-hmm.
One of the things that I always, talk to our investors about, and even some other syndicators about, is the discussion of the cap rate. And like JC mentioned about, really the focus is on the exit cap rate. And really that should be where the focus is, because I hear so many people that say, oh, I only buy at a 7% or I say an 8% cap rate. And going back to what Anna said on an earlier discussion about, there has to be enough profit there for the sponsorship team. I look at it and I say, all right, if I buy a property or that I can exit in a 5 cap market versus an 8 cap market, right, when I go to exit, even if I let's say I increase that value of that property by $100,000 on a 5 cap market versus an 8 cap market. In an 8 cap market, I've only increased the value of that property by $1.25 million versus on a 5 cap market, I've increased it by $2 million. And then, of course, some people might say, well, yeah, but if you buy in a 5, you're probably only going to be able to exit at a 6. I'm like, well, I'm still at 1.725 versus your 1.25. So I'm still doing better than you as far as an increase in the valuation. And if my 5 goes to a 6, your 8's probably going to go to a 9, 10, or possibly even an 11, because obviously the market has actually shifted at that point. So I definitely think that the focus should definitely be on that exit cap rate. So let's talk about that exit cap rate for a minute. Where do you guys try to look at for the exit cap rate? Are you trying to stay in a certain range to be able to maximize that profitability for you as the sponsorship team, but also for the investors? Or does it not really matter where that cap rate is as long as you have a solid exit cap rate based on the entry?
Yeah, so I think that's an interesting point, because the exit cap rate is based on, typically people will say, well, if I'm buying at a 5, I'll exit at a 5.5, or I'll exit at a 6, or maybe I'll go 10 basis points higher for every year I own. And I think that's a really tricky one, because if we're not even buying entry caps, going in caps, then, well, we shouldn't be using them as a factor into determining our exit cap. So like JC said, 100 down units. I mean, I'd love to buy 100 down units at a 4 cap. That sounds like a home run. But I'm certainly not going to sell that stabilized asset at a 5 because I went from 4 to 5. I'm probably buying
that's a great example. Very good example.
Right. So to me, I think it helps to actually be in the market and bid on more stabilized assets and core plus assets and find out what is the market really trading there, and talk to brokers and know the market and say, well, real deal example, if I'm buying something that's 1970, because hey, if you're buying something that's 1980 today, 5-10 years down the road, that's going to be an equivalent 1970 deal, and we'll have that discount associated with it. So today in the market, a 1970 stabilized deal, what is that cap rate? And then from there, maybe I'll increase it by 50 basis points. And I think an interesting point I'd love to hear JC and Anna's take is, with the new interest rate environment, so rewinding into 2018, everyone thought interest rates are going to the sky and our exit cap rates should be 7%, 7.5%. And so we're really wide on our exit caps. And I think now with interest rates and this lower for longer mentality in the market, I'm wondering if people are looking at exit caps a little tighter, maybe bringing it in 50 basis points over market.
Yeah, I'll start here. I was just going back to the cap rate, exit cap conversation, then I'll come to what you were talking about, Rob. So I printed out a sheet that I've got here of deals that we've reviewed in our office over the past couple of weeks, and it's 15 different multifamily deals, all value add acquisitions ranging from 1970s vintage to 1990s vintage, Texas, North Carolina, South Carolina, Vegas, Colorado, Florida, Panhandle. And the range, I would say, on the underwritten exit cap by the GPs who sent us that is ranging from 575 to 675. And that shows you, and that's just hard data from the market. So I thought that was good to share just what GPs are seeing out there as far as exit caps.
I think those are good. I mean, I think that's very relevant. And I support that data from what I'm seeing as well. And I'm happy that you shared that, JC. It's super useful.
Yeah, and I think that was just kind of a good touching point for everybody. But then the interesting thing is that the per unit exit on each of those deals ranges from $72,000 a unit to $135,000 a unit. And so again, everything's relative in this world. And for me, especially in multifamily, I want to hit hard on what Rob said, that it's calling the local brokers and having somebody that you trust that's in that market, maybe a competitor of yours who owns deals there, and saying, hey, I know you passed on this deal or you're not currently bidding on this one, but what are your other deals valued at? What do you think a 1970s pitched roof deal that's 250 units in this submarket, is it worth 60 a unit today? And do you feel comfortable exiting at 85 a unit in 3 years? I just think, for me, being in Texas and not being an expert in every market in the United States, but underwriting deals and investing in deals all over the US, I think it really is digging into what the market is justifying as far as cap rates. And again, really not holding any weight on the entry cap.
I agree. I don't have much more to add to what they've said about exit cap rates. I think we've beat that one down.
Great. Let's move to a question from one of our attendees here. Devin's asking, how do you make the numbers and assumptions as close to reality as possible while underwriting in the spreadsheet?
It's a tough one. It's really everything we're talking about now, and reality is changing. Reality is relative, and there's no one magic answer or silver bullet. There's all these nuances, all these little details, and you can get in the weeds if you want. You can keep it high level and really focus on price per pound and how the deal feels to you. But there's no secret sauce. I think the question might be, how do you be conservative? How do you be realistic? And I think one of the main points that many people miss is just the time it takes for these deals to happen. You don't renovate 100 units in a month or 3 months. And especially if you're penciling to remain if you're buying something that's 95% occupied and you think you're going to turn 100 units, you probably won't do that in the first year, because if you're planning on maintaining that occupancy the whole time. So I think that is one way that people miss reality. Maybe people have it in their mind, well, I'm going to be conservative on my exit cap. I'm not going to grow rents to the moon. I'll just do 2.5%, or maybe it's a hot market, I'll do 3%. But a lot of people miss that stabilization period. It takes time to lease up. It takes time to renovate and things like that.
I think on the expense side, one thing that's really helped me out is all the markets that we get into. If you want to find information, you can get it. And so I like to call local owners of real estate, one, because there's probably a chance to build a relationship with that individual by just calling them and saying, hey, we're bidding on a deal in your market. I heard that this is your market. And so I'd actually like to know, you own 4 1980s vintage, 250 plus unit deals. What are those deals operating on? G&A, administrative, taxes? What's your per unit? What's your usual turn cost? And you'd be surprised, more often than not, people are willing to share that information in a redacted or general number over the phone. And so again, I think it's speaking to people that actually own and operate these deals with boots on the ground. And that helps me dial in as to what the expenses are really going to be like. On the other income and obviously rents and what's achievable, I think, again, that is really digging into the market, understanding not the sub-market, but the 5 deals that are around your property and which ones you're competing with and which ones you're not, and understanding where you're going to fall and why a renter is going to come to your place and pay $75 more whenever they can stare at the deal across the street that's $100 cheaper. So again, as Rob said, we could spend 5 hours going through a pro forma and completely nerd out on it. But at the end of the day, it comes down to really just getting comfortable with your numbers. And then after that, hopefully getting some backup through some affirmation of a local owner or expense comps or deals that you currently own and operate. And then from there, again, getting comfortable with the operator.
Yeah, and then I also think that it's important that especially new underwriters, new people doing acquisitions, realize that the underwriting is just the first step. You're creating a business plan, and then you've got to execute that business plan. So, if you're going to get those returns for your investors, you need to make sure that those expenses and everything that you've budgeted, basically, that you are actually driving that through your asset management, and that you are getting the asset to perform, or making whatever adjustments necessary if it's not performing. And I think sometimes new underwriters just get caught up in the weeds of the underwriting and miss that's just the beginning. That's the very beginning step. And then the underwriting it becomes the budget that's going to carry you through. It's a business plan. So I think it helps to look at it that way. Is it create your business plan, make it as realistic as possible, and then figure out how you're going to execute it with your investors. Well, for your investors.
So I have a question that came in here for Ann, directed at you. Can you comment on the 2 to 3 deals that haven't worked out for you? And was this due to an underwriting factor or some other factor?
2 to 3 deals that haven't worked out for me?
Yes.
I don't have 2 or 3 multifamily deals that haven't worked out for me.
No. From a acquisition standpoint.
Oh, sure. So for when we're looking at deals, so when we're turning deals away, the very first thing I'm looking at is market demographics and micro neighborhood. So a lot of times when people bring us deals, they just don't fit the profile. We have a very specific profile that we look for. We are taking very specific data science numbers and applying them to real estate. And if the micro neighborhood doesn't meet our objectives, I don't even need to see the underwriting. I'm like, sorry, that's not a neighborhood that meets our objectives, and we're not going to bring our investor money there. I don't need to see the spreadsheet. So that's the first thing, is the demographics and the data science of it counts a lot for us. That's part of our, one of our differentiating brands. If any of you have listened to Neil Bawa, he doesn't just talk the stuff. That's how we do our business. And then, other than the data part of it, there might be underwriting that, wasn't up to par for what we're looking for. So it can fall apart there as well.
So the next question here is directed at everybody again, is if the market went down in the next few years, how would you factor that in for the exit cap rate? And I think you could also talk on some different things that you do in your underwriting to mitigate the risk of some form of a downturn as well.
Yeah, I'd like to start with that one. So everybody, I guess, currently is some type of market guru and has a crystal ball, because everybody's been forecasting that interest rates were going to go up, that there was going to be a market correction, that we've been in the 9th inning for the past 4 years. And at the end of the day, again, like I said, I work for a couple of principals who have survived 3 cycles, the 80s, the 90s, and the latest Great Recession. And the way that you survive those is, again, obviously at a basis that you feel comfortable going in at, not being the first person to quote unquote make the market, is always a good place to start. I think the second way to do that, and a way that kind of the industry has changed since '07, is that financing and having conservative financing is another good way to insulate yourself from that. So sure, you can spin out your IRRs by going and slipping a mezz piece in there, or getting some pref equity in and really kind of stacking up the deal. But those rent growth assumptions that Ann and I spoke about at the very beginning, those are the first metrics to really pull back. And if those have such a large impact on your deal, then you don't want to be highly levered, because that's whenever people start tossing the keys. Yeah. And then again, just overall being conservative on your purchase price and your deal. Obviously, you're trying to make your group money and you're trying to hit, mid to high teens, whatever your return hurdles are. But at the end of the day, and Rob and I have spoken about this, it's good to have an Armageddon underwriting scenario. Yes. And at the end of the day, you don't want to lose your investors' money. So if a deal obviously doesn't make somebody money, kind of tough luck, but if you don't lose people money consistently over your career, then that's a pretty damn good gig. And so I think if Armageddon can happen and you can really just tear apart the underwriting and you can get out clean, I think that is a really good way to do it. And by Armageddon underwriting, I mean zero financing, negative rent growth, complete blow up of capital markets, and just literally your deal screeching to a halt. And so that's kind of my take on that. But again, people think that they're market gurus. And if you consistently underwrite conservatively in your deals, it's not healthy, I don't think, to go into every deal fearing some type of large macro event.
Yeah, that's the tough question is how do you forecast a recession into your model and then make any deal look good?
Exactly.
All deals in a recession are going to really struggle. And so the harsh reality is if we do have a recession tomorrow, in a year or 2 years from now, everyone's pro forma that they're underwriting to today is out of the window. And so, and even more of a harsh reality is most people are underwriting with extreme optimism, and that optimism we hope doesn't, or, you know, we hope the market doesn't panic or go down, but nobody's certainly forecasting that into their assumptions, because otherwise they would never buy any deal out there. So it's going back to Dan's original question. It's really a question of, we know valuations are high now. We've been in the ninth inning forever. And how do we still make sense of buying deals on a relative value basis? Obviously, if you're sitting here in 2019 and thinking, well, I'm not buying anything unless I can get a 25 IRR, because that's what I was getting on 2010 deals that deals I were buying in 2010. And that's not going to happen. It's a trick of, well, most people are achieving, let's say 15, 16%. How do I beat them on a relative basis? 17%, 18%. I'm not going to beat people who bought deals in 2010 because they're buying deals for a steal and financing them at 3%. So that's really the relative value question of any market, but especially of today's market with high valuations. And then I think what Dan was really getting to was the downside protections from break-even occupancy,
Right.
and you know what happens. Especially one of my favorite topics is bridge loans, because a lot of people fear bridge loans and stay away from bridge. But for us, we think it's really the most efficient and effective way, and sometimes the only way to pursue a true value add opportunity. And no, not all bridge loans are bad, and you know they make your deal too risky. It's just a question of, can you refinance the bridge loan after you've implemented your business plan? Is there a nice cushion that if you hit your business plan to a T, is there just enough proceeds on the back end to take out your bridge? Because that's not conservative. It should be a nice, healthy spread that if I'm going in with a $10 million bridge loan, I should be projecting that a 75% LTV agency loan should be 11.5 million. So if I don't hit all my numbers and I can only get, like we like to talk about, worst case scenario, can I at least do a cash neutral refinance and take out my existing bridge loan and do no cash out on the refi? So I think those are ways to get comfortable with buying with these high valuations today.
Yes, I agree that bridge loans have gotten a really bad name because people are really scared of them. But in some cases they are, you know, obviously if the occupancy is under 90, then you don't have a choice. But even for some where it's over 90, it can be there's some good bridge loans out there. I think bridge loans have changed too. And it can be the right tool for the plan that you have. If you're getting if you're getting long agency debt, but your business plan is to exit in 3 years, that can be a big mismatch. To have, to not go bridge. If you're going a 3 to 5 year project or 3 or 4 year value add lift, then the agency debt might not be your best friend.
Yeah. And just for the record, I think I'm a big supporter of bridge loans.
Yeah. It's a tool that we can use. I mean, you have to use the right tool for the right project. And we can't, there's no reason to be scared of bridge loans unless it's the wrong tool for that project.
No, and I agree. And I think that there are bad operators out there that are, loan to own guys. And so I think you just need to be careful whenever you go to private financing sources, because people think that everybody's out just to really take the deal back. But just from somebody that we own and operate, as I mentioned before, a bridge debt fund, the last thing we want to do is take over a deal. We don't make any money on it. It is a terrible process. It is such a loser from our end, and it makes us look bad. And so, again, I think just being smart, because there are people out there who are not people you would like to do private financing or bridge lending with. So I think just being smart, but I agree. I think on a weighted cost of capital basis, it can really be a good model if done correctly, like Rob said, done conservatively.
And then going back to your point of layering in a little slug of pref or levering up to 85%, things like that. It all makes sense based on the project level return. And so, like Anna mentioned, matching up the debt with the project, there's no harm in putting on a mezz piece that maybe costs you 10% if the return behind it is risk adjusted and it takes you to a incrementally higher return from let's say a 16 to a 22 or something like that. It's worth paying that extra interest and getting the higher leverage. But if, for example, I mean, even looking at senior debt these days, a lot of people are buying with no spread from their cap rate to their cost of senior debt. And so that puts you in a really tough, I mean, it's really, there's no positive arb on your leverage. And so it's looking at that positive arbitrage on leverage even further up the capital stack on subordinate financing and your preferred equity. So I think there's deals that we look at and say, this could really make sense layering in a pref piece because we're getting a 12. And if we can put pref at 10, we're getting a spread on that.
Well, and also people forget that every time that you get a bridge loan, it's usually an A piece and a B piece. So you're essentially getting mezzanine financing. So be sure and read your loan documents, because if you're getting at a 75 or 80% loan and the blended rate is 7.5 or 8%, there's usually an A note at 5.5 and another piece at 9.5 or 10%. So just make sure that you understand what's going on behind the curtain.
Another question coming in here from Andrew is, for those of you who have gone through a downturn in the past, what were the vacancy rates you saw on your multifamily portfolios during the downturns? And did you see a large difference in vacancy rates in different parts of the country?
I think that one would be for JC.
Yeah, so I have not been through any major downturns. Luckily, I was getting a college degree from the 07 to 2011, so that was a good time to be in Austin. But we have seen in Houston and in Texas an oil price downturn that significantly negatively impacted. And we also had Hurricane Harvey that was one of those macro events that really devastated our multifamily market, but in turn ended up saving a lot of Class A developers. So based on the historical occupancy, just because, like I said, my principals have owned through multiple cycles. I mean, in the 80s in Houston and in the 90s and in 2007 to 2000 and call it 10-ish. I mean, the occupancies could get into the low 80s and even the high 70s for some properties. I think given that financing is more regulated than it was in the 07, time when everything blew up, I don't think that if there is a downturn that's going to come, I think that we're kind of looking at, and if we did have a crystal ball, which I said nobody has, I think maybe a 10 to 15% market correction overall is kind of the worst case scenario that we're looking at. And that can go as far as rent increases, occupancies, and that's for a market wide drop that significant, that would have to be a very mega event.
So let's shift and talk about the debt some more, and how you're underwriting and projecting debt. Since we've all obviously talked about that on a couple of different points and discussions here, when you're underwriting and projecting debt on a property, what are you doing as far as making sure that your underwriting is conservative for that deal, understanding that every deal is a little bit different, but there's probably certain things that you do to make sure that you can mitigate risk based on the debt as well.
Well, we get our lenders involved very early. So, when we're serious about our deal, we've got our, we have term sheets that we're getting them involved and getting their input and working with them. So we have a good understanding very early what we're going to be able to get on this project. And we're like a team. They're part of our team. So we're working with real knowledge. And maybe it's, it's a good position to be in I would hope that everybody's working closely with a lender. They should be part of your team.
Yeah. And it was similar to the last discussion we were having about cost of capital and matching the right debt to the right deal. And when a bridge loan is appropriate and when it's not. And it goes back to cost of capital. Like I was saying, a spread, if you're buying at a 5 cap, maybe that's not so bad. If it's, even if it's stabilized, there's not a lot of meat on the bone, but you can get debt, which today we're getting 10-year money quoted at 158 over treasuries, which is about 3.6%. So, if we can lock those rates and buy at a 5.5 cap, that's a great deal. All of a sudden, all deals look a little better. And, but on the flip side, looking at the pricing of bridge loans and the different costs associated with higher leverage or lower leverage, it goes back to just does the deal support it? And I think that's what it comes down to.
Yeah, I want to go back to what Anna said about really matching up your financing structure to what your end goal is, because more often than not, people are calling us on the bridge side because they're looking to get recapitalized because their rehab took longer than they thought, or their investors wanted to pull out of the deal, so they're having to replace that $2 or $3 million piece by either refinancing. And so I think really having the aligned interest of your lender and your business plan going side by side is super important, and not really going for the cheapest option is something that I really want to hit on also, because there's a lot of groups out of LA and Chicago and New York that will provide these loans that are, maybe cheaper on the ticket price or can give you higher leverage, but people forget to ask, well, how is your draw process? So if you're doing a heavy rehab and your lender's holding back, millions of your dollars and charging you interest on it, and they can only do that every 4 or 5 months, or they're really, more loan to own type guys, or they're just not very fast processing the deal because they sell the note and you're dealing with Midland Servicing or Rialto or it's one of these other groups, it can be pretty painful. So I think picking a lender is really picking a partner in the deal.
Exactly.
It's not somebody that you don't need to think of it as a big banking institution like they're overseeing your deal. You need to be in with them and be extremely comfortable with them, because at the end of the day, they're the first lien holder in your property.
Yeah, and the other thing about interest only, I mean, we're not seeing many projects that we can purchase without taking advantage of interest only these days. So, 2 to 4 years of interest only is kind of necessary with the pricing that where assets are these days. But that has to be done very carefully, right? So you have to be able to execute your plan, and during those times that you've got the interest only, you need to be able to really push your NOI and improve the value of the building. So it needs to be used judiciously, but I'm not seeing a lot of projects coming through my side that don't include some amount of IO. Agreed.
So how do you mitigate the risk? Obviously, I mean, I understand the concept as well, as far as, if the deal makes sense to be able to put some bridge financing on there. But some would also argue that it makes it for more riskier of a deal, because what happens if 3 months into the deal, 6 months into the deal, market turns, you get that 10 to 15% worst case scenario, and now you can't make the mortgage payments because you're now, you've taken too much leverage. Because we look at back in 2007, 8, 9, the properties that did default, which very few did with multifamily, but even if you look at those the ones that did default, there are assets that were way over leveraged that they just couldn't make those payments, and those are the deals that went south. So how do you, right now, when you're taking a bridge loan, how do you mitigate that risk in taking that 85% plus leverage?
I think there's 3 ways really to look at the risks and mitigate them. Is number 1, reserves, whether the lender's holding interest reserves and you can draw from that to make the mortgage, and then cash reserves that you just hold in your operating account. Because like JC said, if, unfortunately you're working with a tough draw process, then you definitely want to have cash to be able to just go ahead and make your renovations, because you're racing against time and you need to just make your improvements happen so you can raise the value of the property as quickly as possible. And so you don't want to be waiting on your lender. So cash reserves, interest reserves. So that's number 1. Number 2 is looking at refinanceability. And that was what I was mentioning earlier. And what we do is we look at, okay, what if capital markets have a dislocation and all of a sudden interest rates go up, or we can't get as much proceeds? Are we still able to take out our existing bridge loan? And then on another scenario would be property doesn't lease up as expected, or we penciled to $150 rent bumps and we're only getting to 100. Well, with $100 rent bumps, are we still able to take out the existing loan? And then it's the double whammy. What if you have market dislocation and you have, your business plan doesn't execute as you thought? So you have 2 things working against you. And I have a little calculator that shows what would be the proceeds that you'd be able to actually get from a takeout lender. And if it's below your existing bridge loan, it's a big red X. So you want to stay away from situations where the downside is not protected from a refi standpoint. And then the third way to mitigate bridge loan risk is I forgot. So I'll come back to it if it gets to me.
Well, I just want to reiterate again that in the business plan, in the execution of the business plan, tracking. So, we've got this plan that we put together, and people are starting, they're turning units, but somehow people aren't watching the real numbers. So they're not, labor costs are higher than they thought, or the kit cost is higher than they thought. And suddenly that you're not getting the returns you thought you were getting. So you have to make sure that you're digging into those numbers every month as you go forward, and you're correcting as you go. You can't wait until a few months later and go like, oh my God, the NOI is just terrible. What's going on here? Well, repairs and maintenance is blowing up. Well, if you're tracking it as you go and you're seeing, and you've got your plan, how many units are we turning? What is the exact cost? Let's got to stay on budget. If we're going off budget, where are we going off budget? Are our labor costs too high? Are the kit costs too high? What is it? Track it as you're going as a team, and that's going to help you keep on top of moving the value of the asset to make sure that you're not going to get in trouble. Or if you are heading down the wrong road, you can do things to mitigate that and turn things around quicker, because you've got the data in hand that's showing you your what's going on at that moment. Don't let it just slap you in the face 3 months down the road.
Yeah, and just because I'm in this market, I'm going to go more, obviously all the underwriting and everything is super important, and the conservativeship and knowing what expectations are and what downside risk is. But I really think that the bridge financing world is a tricky one. And you need to be very careful about who you choose, because bridge financing is a broad term. There's, different ways that people can get behind the cape, and they can really be hard money guys, or they can be just guys who are issuing notes. Like I said, there's a lot of bridge financiers out there that are going to have 2 or 3 different notes going on behind the curtain, and they're going to sell that paper, and you're going to be stuck with whatever servicer is going on there. And then there's guys that just want your asset, and they're going to seem really good on the front end, but if you sneeze wrong, they're going to take your deal. So that's really, I think, the biggest thing when picking a bridge lender or a private financer or anything is get references. Ask for them whenever you approach somebody. If you're getting a bridge loan, say, I want to speak to somebody who's done deals with you previously. And we offer those up all the time. And I think it's, 1, a good way to get business, and 2, just to check and see, because if somebody's had a bad experience with a bridge lender, I can promise you they've never gone back and done another deal with them. And so that question is one that I think is really good to ask. And then at the end of the day, the underwriting standards are super important. Private financiers don't operate within the regulations of the United States government or banking institutions. And so make sure that, you check their model and understand what rent growth and what stuff that they're doing, because sometimes those guys will just say, sure, if it works for you, it works for me kind of deal. And so you need to make sure that you understand who you're doing business with on the bridge financing side.
That opens up a whole nother can of worms and discussion when you start to think about the lenders wanting the deal to go south because they want the asset.
It's a sad reality. And there's a difference between synthetic mezz and pref financing and pref mezz, and how you can sell the paper. And I mean, there's just 1,000 things that can go on Wall Street that you don't know is going on. So make sure your legal counsel's digging into the loan docs and you know who you're doing business with.
I think also looking at their reputation from somebody like yourself that's working with these bridge lenders all the time, and so you kind of see what kind of deals they're taking on, and if it's a really high risk deal, so they could potentially have the asset and various things like that as well.
Yeah, we've gotten turned down by several people that have used what they thought was lower cost financing sources out of New York, LA, and Chicago, and they've called us back 2 years later telling us what a nightmare it was, and just how they've almost lost their deal. So just be careful out there.
Wow. So speaking back to what Rob was saying about the operating reserves, where would you guys feel comfortable, or where do you guys feel comfortable in your underwriting when you're basing a deal, let's just say, on that bridge type financing as well as the agency financing? So where would you put those operating reserves, those targets for a deal that you're underwriting? Because obviously it's going to change based on the debt structure.
Yeah, just the way that we do ours whenever we do bridge financing is, as Rob said, depending on the vintage of the property or how much that they're doing rehab on, it can range anywhere. I'm never going to do 250 a unit on reserves. It's going to be more on the 300 to, if they're doing a large rehab, then justifiable $300 a unit, but call it 3 to 350 per unit on the reserves. I'm going to make the borrower do reserves for insurance, taxes, and replacement reserves every month, so that at the end of the year, they have enough money in an escrow account to pay those in full, no matter what happens before anything happens on distributions. Before they pay their investors, all that money is in a separate account ready just in case something happens. And then from the interest reserve perspective, because a lot of people are doing value add deals or there's some down units, we usually do incorporate an interest reserve. And the way that we're different is we don't really charge people a negative ARB, which some people will out in the market. But those are really how we safeguard ourselves from any potential mishaps on taxes, insurance, or CapEx.
Yeah, and just to clarify for everyone listening, those reserves JC's talking about is ongoing replacement reserves, like you said, made every month, and that's out of revenue and cash flows. And so then there's also the going in operating reserve, right? You're buying a business, 10, 20, $30 million business, and businesses don't operate with no money in the bank. So you want to have, for us, we typically look at 2 months of operating expenses in the bank as a cash operating reserve. And then we let the lender, obviously underwrite to their interest reserve and then try to beat them up and get a lower one, because like JC said, most lenders are charging a negative ARB on their interest reserve. And what that means is they'll say, hey, this deal doesn't support the mortgage for the first 6 months or something, so we're going to need to hold back $200,000 in interest reserve. And in the meantime, while we're holding it back in our own safe account, we're going to charge 7% on it to you, the borrower. And so that's never fun for me. And I also try to get the lender to agree not to charge interest on the CapEx, on the unfunded portion of the CapEx. So if the lender's holding back the $2 million CapEx reserve for us, I only want interest to be charged on what I've actually drawn and used for renovations. And I think there's one more reserves. We have the going in operating and then the ongoing. JC hit that one. And is there anything else?
Taxes,
insurance, right?
Yeah.
You got it.
Awesome. Well, we are coming up to the last few minutes of our panel here, and I have one last question in here that I have in the Q&A box, and it's about, do you guys use any underwriting software or use your own spreadsheet based on underwriting most of the time? I think I know the answer to every single one of your answers, but I'll let you guys go ahead and answer that.
Yeah, we have our own model that we use internally.
Yep. We build and maintain and edit and make it perfect for each deal, just how it needs to be. If the lender is going to charge interest on the negative ARB on the interest reserve or on the CapEx, we factor that in. Or if they'll charge it as it's drawn, we can factor that in. So it's very deal specific. And I think most people will agree that using a software makes it much more difficult to create a deal specific underwriting model.
Yeah, we actually we get a lot of underwriting. People like Rob and different people send us their underwriting, so we look at those models, and then we have our independent underwriters that write as well. So I've got a lot of different models that I'm looking at. We also are working with new construction as well, so we've got quite a few different models going through student housing. So yeah, I mean, I don't use a software because it's too limiting, but I use software as data points, and then pull those data points out, operating expenses, different benchmarks, but we basically do it all in spreadsheets.
Yeah. And I think, what this person is referring to is some of the more mass marketed ones that are kind of generic for multiple types of projects and deals. And I think those are good to kind of get started with. Yeah. And they're good as ones to kind of learn from. But, like every one of you just mentioned, you have your own. And so once you get to the point of learning and knowing and figuring out how each one of the levers can be modified and moved and changing the different factors, it is important, like Rob said, to make sure that you have your own, that you can customize based on the deal, because sometimes these models that are out there that are mass marketed, they don't take into account every single piece of nuance that could happen on a deal. And it's good to have those models that you can customize for your specific group.
And also one more thing too, is that at the end of the day, you can't underwrite a deal a week, so you need to know your model because you need to be underwriting hundreds of deals every couple of weeks. And I know that Rob and Anna both do, and I do as well. So if you kind of customize one yourself, you can get it in there and do a quick rough and dirty underwriting on a deal just to see if it's even worth calling the person back. And I think that's really important because you're just really need to leverage your time.
The underwrite is very important. Yes.
Yeah. And my last point there is if you're on the fence of, should I use this model? Should I use that model? Should I make my own? And you think that you really want to gain the most and the most knowledge, understanding, building your own from scratch is going to provide far more understanding of how all of these different numbers work with each other and to, garbage in, garbage out, and how that all comes together in the model. So if you're on the fence, go for it. Start building one. Try to look at as many models out there and take parts that you like, take parts that you don't like, and make it your own, because you need to have full faith in your own model as you're underwriting, because that allows for speed and confidence. Yeah.
But you got to check your model, because I've had people submit models to me that they made on their own, and there were some pretty big errors in their formulas, and so then I don't have confidence in their underwriting because their model is wrong. So if you're building your own model, you need to somehow be able to test it against other models that you have confidence in that are correct, to make sure that you're getting the same results. So
send those to Anna, and she'll pull them apart.
I will shred them for you.
Yeah, I couldn't agree more. I've had multiple models sent to me, and I'm not a smart guy, and I'm not a numbers guy. And if I can find a miss in your model, then that's a pretty good indicator of what future business is going to be like. So I'm usually a pass.
Yeah.
Well, let's take a moment here and have you guys go around, starting with JC and then Anna and then Rob, and sharing how the listeners can reach out to you if they want to contact you further and start to follow you.
Yeah, absolutely. So I was the black sheep of this group that came in last minute. So hopefully I'll be able to circulate my contact information, and you can also reach out to me on LinkedIn, and we can connect there, or our website is flagshipco.com. All of my information is on there, but I will work with the administrators to make sure that I can send out my full contact information. And please reach out to me as a resource. If anything, if you're ever in a market that you have a question on, or if you would like a quick model that I can send you, at the end of the day, I'm happy to help people that are building their own business, because I've been in this industry 10 years, so I'm not a veteran by any means, but I've learned a lot along the way through kind of skinning my knee. And so if I can help anybody out there really not have to go through some of the pain that I went through, I really enjoy helping somebody else that's kind of trying to put their toes in the water.
By the way, JC, is that a wine cooler in the back? Is that a little wine?
It actually is. So I am not in my office currently. So,
so you can find me. I'm Anna at growcapitalist.com. My information is there. I'd also like to encourage all of you to join us on multifamilyu.com. We do a lot of webinars and that are free. This Monday, for example, we've got an interview with CoStar. We've got lots of stuff going on over the summer. We've got 4 different CoStar market reports that are going to happen. I'm so excited about those, as well as different lawyers and all kinds of syndication special stuff going on. So make sure you connect with us at multifamilyu.com and start engaging.
And if you want to learn more about what we're up to, or subscribe to my newsletters, you can go to lonestarcapgroup.com, and you can email me directly at rob@lonestarcapgroup.com. Happy to send my model, or like JC said, have any discussions on any deals you're looking at, or any other opportunities.
Well, JC, Anna, Rob, thank you so much for participating in the panel. Looking forward to continuing to follow you, and hopefully you will mark your calendars for the January 2020 summit. We'd love to have you back again.
Thanks, Dan.
Thanks for having me.
Thanks, Dan.
Thank you.